A couple years ago, I watched my grandfather's account drop by about 500,000 in just a few years. And it wasn't some market drop. It wasn't a poor decision on his part. It was a middle of the road long-term care facility in Spokane, Washington. I can assure you he wasn't walking around on marble floors. $500,000. I mean, that's a big number. And unfortunately, this isn't just an anomaly. Genworth just came out and said roughly 70% of people over the age of 65 can expect a long-term care event in their lifetime. 7 out of 10. Many of us are living longer, and because we're living longer, we need a little help living. And that's what we are here to talk about today. My name is Michael MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. I'm joined by Valerie Escobar, who's also a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. Valerie, how we doing?
Good. Interested to talk on this topic today. It's not exactly, it's not super fun per se, but there is a lot of planning, that can be done, a lot of solutions out there. And so I think for that reason, it can be a positive thing.
Right. Yeah. And that's what we want to touch on, the different solutions that are available, what legislation might force you to get some type of solution or pay a tax, that is, and really how you should approach this. But speaking of approach, there is a colossal obstacle that sits in front of all of us anytime we start thinking about this. And in a lot of ways, I think it has to do with the fact that we seem to fear degeneration almost more than death. I mean, I certainly do.
Yeah. And I hear that. I mean, and how often I can tell you that clients just say, oh, just push me off the cliff. I feel like, and everyone thinks that they're the only ones that have said that. Like I hear that more often than, let's plan for this.
Right. Yeah. I'll never go into a home. And, in a lot of ways, I think we live in denial of this. And, if you imagine just waking up every day and truly thinking deeply about your departure from this realm, you might not get a lot done, and you probably wouldn't be that fun to hang out with.
Agreed.
So it's really evolutionary in that way that we don't dwell on this every day. It's a luxury, but that's simultaneously why it's so difficult to plan for. So, I mean, I have to imagine you see this as well, Valerie, like just in different forms with clients.
Yeah, no, there's definitely a denial to some extent that, again, I'll just, so just off me at that point. Or, it's just, it'll be fine. Somebody else will just come and take care of me because I'm never going to a home. That's just never going to happen to me. As if somehow just, declining the possibility will somehow solve the issue.
Right. Yeah. Yeah. Hey, I'll never go into a home. I'll I just won't ever let that happen. It's like, well, you might not be able to consciously make that decision at that point in time.
Right. And one of the things too, that, the decision isn't yours because it's,
right.
At that point, but it's also like, if we're thinking about it, it's a decision to plan for this is a decision to not put your family through this.
Right.
And
so, anybody that's been through this, and again, I don't know if you've been through this just personally. It seems to have touched more and more people, but the familiarity of it seems to enlighten us to say, hey, we should probably do something about this. But there's still many people that I meet with that just haven't gone through it. And so I don't think they truly respect the time and just personal commitment that's involved when there really isn't a good plan there. And I think there's a tendency to maybe just say, well, I'll just self-insure. And it's like, well, that's not a long-term care plan. That's just maybe a funding option, but it's really not a plan. And I think one of the other fallacies that just kind of exists out there is, well, hey, this just isn't a priority for me right now. We all have busy lives, and it's just so easy to keep kicking this down the road. But that's why we're here to talk about it today. So let's just touch on what LTC is. What is long-term care from a definition standpoint? It's a broad term. It's used to describe a variety of services and supports for those who can no longer care for themselves due to age-related impairments typically. This care can be provided at home or in a facility designed to care for those who can no longer complete the activities of daily living. So these are called the ADLs: bathing, grooming, dressing, eating. There's actually 6 of them that we typically look at. And if you can't perform some of those well, you probably need some help, because those are daily living activities. And if you can't perform them without risking your own health, again, you probably need some help there. So, um, some quick stats on long-term care, which can be assisted living, nursing home care, in-home care provided by a home health aide, family caregiver. But just some quick stats here. So seniors age 65 and older, well, they have about a 70% chance of requiring some form of long-term care services, as we touched on. That's a Genworth stat. Women tend to need a little bit longer care. They tend to live longer in these homes, 3.7 years for women versus men at 2.2 years. It's certainly important when you're kind of thinking, hey, how much do I really need to set aside for this? How am I funding this, right? But there's also some legislation that might require you to just get a policy in place or have to pay the tax. And many, I think, are unaware of this, but in my home state of Washington, they actually instituted a payroll tax for a long-term care plan. And it wasn't that great for a variety of different reasons, but the only way you could get out of it is if you had a qualifying private plan. So more and more states are looking at this, because Medicaid is just so expensive and so many people end up needing long-term care services that the state has to raise funding in some way. So they're saying, hey, maybe we should tax this. Well, if you have a private policy, it's looking like you'll be able to opt out of these new state-run plans if they do come into effect in your state. But, if you don't want to end up in this situation, right, it's important probably to look at the costs and build some solutions. So what are some of the costs that we see with long-term care right now, Valerie?
Yeah, so costs will vary, obviously, based on geographic location, the kind of services you get, et cetera. I think they tend to correlate to where you live. So in the Midwest, because costs of living in general are lower, you'll see lower costs than on the coasts. Where, and if we're, again, looking at Genworth, and Genworth is one of the biggest providers of insurance, long-term care policies as well. And so they clearly have a lot of great data. But nationwide last year for 2021, to have a home health aide, so somebody that comes into your house to help care for you, averages about $62,000. And I think what's most startling is that this is a 12% increase from the year before.
Yeah.
How those costs are going to continue to go, it's hard to say. But that is a person that would come to your house and help you. And then what home health
Not full time either. Yeah. Just,
and that's what the other thing I was going to say is that a home health aide, there is such a variety of, what are their qualifications? What can they actually do? That number to me sounds really low, because a lot of the providers that I've talked to say that a qualified, somebody that can actually administer medication and take care of you will be similar to the cost of a just being in a facility full time. Mm-hmm. And that facility cost, if you're in a private room or semi-private room, I mean, frankly, it's about the same. It's about $100,000 a year. Mm-hmm. But the handoff is that if you're at home, you still have your home to also pay for as well.
Right.
So certainly not cheap. In the Midwest, again, I usually use about an $80,000 cost. And if somebody is out on the coast, then I would say, well, let's look about $120,000 a year.
Yeah. And there's, I think, this belief sometimes, well, I have Medicare that covers it, right? Only for a very short period of time and a percentage of the costs, right? So
there's so many different, hoops to jump through as well to get there. You have to impoverish yourself, and there's a look back period.
Yeah, if you get on Medicaid, correct? Yeah.
Yes, yeah. Yes, I'm sorry, the Medicaid costs. Plus, facilities will have certain number of beds that are allocated for Medicaid, and so it's not just that you can pick whatever you want.
Yeah. And just one personal story on the home health aide, because, a lot of people don't want to leave their home, which is understandable, like really understandable. We had a nurse that was helping out, and eventually it just got to a point where, my dad and my uncle were just fearful that she wasn't really taking care of him in the way that she should have been. And I think we have this tendency to believe, well, our health system, if we have care there, then they're being cared for. And it's just kind of universally this some form of long-term care that exists, right? Like sometimes people say, well, I'll just go on Medicaid. I'll just burn all my assets down.
Mm-hmm.
I don't think you'd want to wind up in that position if you saw what that really meant. There's been a ton of stories that have come out for how these facilities have treated those on Medicaid versus other forms of long-term care because of the billing, and it's just really not perfect. It's a new form of care that's kind of taken precedence with like how do they navigate all these different policies, and because of that, I think a lot of people just maybe aren't getting the care that they want. And if you're a loved one taking care of somebody, or caring for your parents, let's just say you're in the sandwich generation, um, it's just it's not something that is as straightforward as you think. Like, hey, I'll just have a nurse come in and they'll take care of it. It's like you really want to make sure this is the right person for the job.
Right. And one thing
Um,
that I've noted too is that when there is, a nurse that's coming in, that all of a sudden, if there's somebody else that's there, there's the privacy is gone, and that, it's no longer your home like it used to be.
yeah,
And
yeah,
so, that solution turns to not be quite what people expected it to be.
yeah. But in like you said, $100,000. Let's just say, depending on the state, you should really look up the state specific costs because they do range dramatically. In
Hmm.
Washington, it's
Hmm.
over 100,000. That's after tax money. So if you have an IRA, it's less than what your IRA says because your IRA has to pay income taxes, right? Which is
Yeah.
how my grandpa went through $500,000 in a little over a couple of years. So it costs a lot. Um, we need to build that cost in from an estimate standpoint. Let's talk through some different types of solutions that we can consider when we're addressing this massive cost.
Hmm. So the biggest one, I guess that we should probably touch on first is just insurance. There are two different main types of insurance that we look at. Long-term care insurance is just a standalone policy. So you
Mhm.
pay for it, and once, like you mentioned, those ADLs, those activities of daily living, those are universal definitions, and so it's not that Genworth or whatever annuity company
Made
or
it up.
insurance company is making that up. It's just
Mhm.
across the board. If you can't do two or three of them, then you qualify for having long-term care, and that long-term
Mhm.
care policy will pay out. There are, when you're talking to your insurer, whoever it is, there are so many caveats, whether you're getting something that's reimbursement versus indemnity, that it just pays you a certain amount of money. Those are specific things to look at. But those policies, they're not cheap. Right. Nothing about
No.
long-term care is cheap. But that will be more affordable in general than having to pay for a long-term care straight out of pocket.
Mhm.
So we look at the long-term care insurance versus a standalone policy versus having it as a rider on a life insurance policy.
Mhm.
The biggest thing between the two is that somebody will say, well, if I buy long-term care, what if I never use it? Well,
Yeah.
you buy car insurance. What if you never use that? Then that's great.
Right.
But there is that big concern because it's such a big cost. And so like adding it as a rider to life insurance means that, you have a death benefit for my, son. And if it turns out I need long-term care, then I'll just use some of that death benefit for my own benefit, and then the remainder goes to him. Or if I never use it, then the whole thing goes to him. So that does lead to a level of comfort.
Yeah. Yeah. And again, the biggest just fear with buying standalone LTC insurance is, well, what if I don't need it? And
Hmm.
that's, as you're mentioning, why the life insurance with a rider seems to be an attractive feature, really why so many people are doing it. You know, in Washington, we had to set up so many of these plans to get people out of this tax because the tax in the plan just it really wasn't set up in a great way here. Um, and most of them opted for the life insurance with the rider. Of course, it depends on your situation. I will tell you that it's typically a little bit more expensive per dollar of coverage because, well, 2 out of 2 people die. So you're guaranteed to get some money, whereas with long term care, you're not. But
Yep.
yeah, the price of this, I think, surprises a lot of people for the coverage. But when you look at the stats of just how many people are going into long-term care and the cost of long-term care, uh, it's not maybe as shocking. But if you're just approaching this from like, well, hey, I'll just check out a policy, like you might be a little surprised. Now,
Absolutely. And
there's some
certainly
different,
when we go through that analysis, our first line of defense, I suppose, is looking at, well, what can I self-insure, right? I don't want to put more insurance on a person than they really need. And
right?
so, yeah, looking at investments and saying, okay, how much of this investments could go out to cover it? And where are the investments? Like you said, an IRA is going to cover substantially less than a taxable investment account that doesn't have a super low cost basis because the tax situation is just less. And so looking at that will be one of the biggest components first
Yeah.
for deciding exactly what that number needs to be for insurance.
Yeah, yeah. And there are some other benefits to buying a qualifying long term care policy. And I will tell you that not every life insurance policy with the LTC rider is just created the same way. There truly are differences out there. And sometimes it might be a little confusing. You might say, well, I thought this was a qualifying LTC life insurance rider, but it might just be like some form of a terminal illness rider that accelerates the death benefit that doesn't fall what's under the 72B guidelines. I had to learn all this lingo when we were looking into this for so many folks, but point being, not all policies are the same. And
Mm-hmm.
there's also a couple others out there that you'll see. And the first one actually did make sense for some folks. It was a asset-based long-term care policy. So you would pay in a lump sum amount, and that would get you a long-term care benefit down the road, a pool of long-term care and a monthly benefit that you could get. There's cost of living adjustment riders that you can attach onto these things. But point being, you put in a lump sum amount, you then get a pool of coverage that typically grows over time and a monthly benefit that can be pulled from that pool. And I think this made sense for some folks that maybe just had some cash lying around and they're just sitting there like, hey, I'm not getting any return on this, but I do want to put this towards something that's maybe a little bit more conservative, maybe a little bit more assured. That's what insurance is built for, right? And so we set up a few of those, anywhere from 10 to 50,000 dump ins. And it can make sense to look into something like that, just if your only concern is long term care and you just want to get the biggest pool possible, right? If you don't have any interest in leaving a death benefit, let's say, to other beneficiaries. The other quick form I'll touch on that I'm not as big of a fan of, but certainly have seen, is a bundled annuity plan, where you essentially put a lump sum in. And really, what's happening here is you're buying two products. You buy an annuity, and then that annuity kicks off some income that purchases a long-term care policy. It's a double whammy for the insurance agent. Two commissions. But this bundled product, again, I'm just not as big of a fan for, a variety of reasons, namely the fact that it's like, it just seems to be doing more. There seems to be more insurance there than really is needed. Um, why not just buy a long-term care policy if that's what your goal is? Why do you have to buy an annuity that pays for a long-term care? So I've seen a few of those, not a big fan of them. But last one we want to touch on is self-insurance. So when we bring that up, Valerie, what are some different ways that we should think through this? Because that gets tossed around a lot.
Yeah. So again, I mean, you're gonna go across and say, okay, let's assume that I'm going to be in Virginia when in my late age stage of life. It's going to cost $120,000. I'm going to assume it increases by 6%. So if we assume that you have a 5-year long-term care event, so that's going to cost you for 5 years that you're going to need to care for that, and that's the end of the plan of
Mm-hmm.
your life there. We say, okay, it's going to cost X amount of dollars. How much of your assets can you use towards paying for that? So again, looking at, where the assets are located and how much of that can be used to pay for that. That it depends. If somebody has a very high, their lifestyle costs $200,000 a year already, and then they're saying, when I go into long-term care, I'm going to want my spouse to be in a facility with me, and so we're going to just sell our house and use that money, the equity in our house, to pay for it. That is a viable option to be able to do that. That is money that, instead of paying for an insurance product, you're just insuring, yourself with those resources to pay for that. And so
Yeah.
I think it's just, if you have that conversation and say, is this a valid use of my assets? And do I feel
Right.
comfortable with it?
Yeah. And I think in a lot of ways, it's just an easy way to not have to think about this. To just say, well, I'll just self-insure. That doesn't mean that it's not a viable option by any stance. I
Mm-hmm.
think a lot of people just say that because, again, they don't want to have to think through the whole thing. But when you say that,
Right.
what exactly do you mean? It's like there's legal pieces to this that are critically important. Like if you become incapacitated, who's taking care of you? What are the decisions that are playing out? And I think one big one is, okay, what if you need long-term care, but your spouse wants to stay in the house?
Mm-hmm.
So what's going to happen in that situation? What if both of you experience an LTC event at the same time? Like start with, I don't want this to be like the fear pod, but start with those worst scenarios because
Mm-hmm.
they can happen. Like this isn't like, oh, that happens 0.2% of the time. These are legitimate chances of this happening. 70% of people need it. So if both of you need it at the same time, that's going to be a huge cash flow need. How are we going to fund that? Is it purely off of your Social Security and your investments? And then we maybe have some contingency plan to sell the house. Do you think your kids might want the house? What if you have a family member living there? There's a lot of things to really think through here that isn't just, do I have enough money for this? There's the
Absolutely.
personal decisions that are important there as well, right?
Mm-hmm. Yep. Just like anything with money, it's always about having that discussion, and
Yeah.
it's not ever just numbers.
Yeah. Yeah, exactly. Exactly. So again, steps for people to take here, calculate the need that you have, assess what it is that you have currently and how that might meet that need. Perhaps that's some Social Security, some retirement income from other assets, potentially some real estate or other forms of income and assets. And then from there, figure out, hey, is there a gap here that's needed? Like,
Mm-hmm.
do I have a gap that is required? And you might be unhealthy to the point where long-term care insurance might not even be an option to you, but it might be a good option. Maybe if you're, let's just say, kind of in your, I think a lot of times maybe in your 50s or early 60s, and you have some gap that's really needed there to fund if you have an early long-term care health event, or if you and your spouse do. So figure out if there's a solution that's needed there on the insurance side, and if there's not, still figure out some course of action to really bring this whole thing together in the most efficient way, so you don't rely on the government's estate plan. You build your own. So hopefully you found today helpful. Again, my name is Mike MacKelvie. I was joined by Valerie Escobar. We're certified financial planners with Mariner Wealth Advisors. Make sure to hit that subscribe button wherever you're listening to this to get more content from industry professionals here at Mariner Wealth Advisors. Take care.
Thank you.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.